Given stock market bulls recently had, for the most part, an unabated run, and given the events of this week, it's an excellent time to take a hard look at the stock market's risk-reward profile. And to help us get a better handle on the stock market's 1-month to 5-year risk-reward ratio, we'll be covering 9 new This Just Happened stock market studies. And those studies will be very, very similar to a study that we posted on Short Takes on February 19th, 2019. And keep in mind, sentiment was still extremely skeptical and bearish on February 19th, 2019. But something that had just happened, something that we could see, measure, and put in a model, told us to keep an open mind about much better than expected outcomes looking out 6 months to 2 years. And thus, given what we knew, this table here, and the evidence that we had in hand on February 19, 2019, and given everything that we knew on December 31st, 2019, and every study that we covered between February 19, 2019, and year-end, in early 2020, it's not particularly shocking that the U.S. avoided a recession in 2019. That's what the data told us. It's not particularly shocking that Brexit is in a better place today from an uncertainty perspective than it was in February of 2019. And it's not particularly shocking, not even remotely surprising, that the U.S. and China reached a Phase 1 trade agreement, because all 3 of these bullet points aligned with the net aggregate opinion of all market participants regarding all subjects on all time frames, and that is captured in a table like this and via a study like this. Now let's transport those concepts to the present day. Given what we knew on Thursday, January 23rd, 2020, which included the fact that the S&P 500 was up 13 out of the last 15 weeks. That's extremely rare. And looking backwards from this point here into the month of October last year, we had gained 12.79%. If we would have told you earlier in the week that the S&P 500 most likely was due for a pullback, we all would have said, yes, that makes sense. That's how markets operate in the real world. And given this 12.79% move was based on a 377-point gain in the S&P 500 from point A to point B, and given that red days, red weeks, corrections, pullbacks, and bear markets are all associated with some type of real-world concern, it's not particularly surprising that we have a new real-world concern in the present day. Given all of this, we knew the market was going to pull back at some point. We just didn't know what the topic would be, and we didn't know exactly when that topic would surface, but it wasn't a question of if a negative topic would surface or if some of this 377 points at some point would be taken back. It's one thing to say in advance that we're due for a pullback. It's another thing to remember that when the pullback is actually taking place and there's something to be concerned about in the present day. November 27th, 2019 video contained this slide about opportunity. 9 new signals. Do they align with opportunity or have things changed? Look at a monthly chart of a stock-bond ratio. If you're familiar with ETFs, think SPY divided by AGG. Monthly chart with Bollinger Bands. We get a bullish MACD cross for this ratio on the monthly chart in early 2012. And that is followed up by a relatively rare move and close above the upper Bollinger Band. And that occurred in March of 2013. This is a risk-on, risk-off ratio. Common sense tells us this leans bullish, and this speaks to increasing risk appetite. Very, very similar situation, November 30th, 2016. Same ratio, same bullish cross on MACD, and same relatively rare close above the upper Bollinger Band for the ratio. Basically had the exact same thing happen at the end of December 2019. Here's our bull cross on the same ratio, and here's the close above the upper Bollinger Band here. this look here and this look here. It's very, very similar to the looks that we just covered at the end of March 2013 and the end of November 2016. Therefore, it's logical to ask, what happened in the stock market walking forward in the two previous cases? This point here in 2013 is similar to what just happened at the end of December 2019, just a few short weeks ago. And the answer is the stock market did very, very well. It tacked on an additional 35.79%, and it rallied for over 2 more years. And not surprisingly, between point A and point B, we had 100% normal and to be expected volatility. And once again, when we look at this over the weekend when the stock market's closed, you say, sure, the market's going to pull back. We all know that. It's a lot harder to think that way on Friday when this is the headline that you're looking at. I can assure you, every single one of these pullbacks was associated with some type of concerning and scary headline and/or data point. Thus, in the present-day case, we didn't know what this headline was going to be, but common sense told us one was on the way. We just looked at the 2013 case. November 2016 is similar to this look here in the present day. Therefore, it would be helpful to know what happened from the similar point in calendar year 2016. The answer is the S&P 500 gained an additional 30.66% and rallied for an additional 422 calendar days. Simply telling us to keep an open mind about much better than expected outcomes walking forward, while maintaining realistic expectations. Study 1 of 9 will be moving quickly. This is a weekly chart of the NASDAQ Composite Index. This is the Relative Strength Index, affectionately known as RSI on the bottom. Relatively rare for RSI to drop below 35 down here and then make it all the way back above 80. NASDAQ inception 1978, so we wondered how many times in NASDAQ history did something similar happen, and how did stocks perform walking forward from this obviously overbought condition? Here are the similar setups here, and from that obvious overbought condition, walking forward, it helps us with that all-important realistic expectation concept. When markets move a long way, givebacks are always part of the equation. Point number 1, there's nothing all that scary in this table. Worst case scenario, a loss of less than 6%. And that is offset by the fact that 5 years later, 85 to 86% of the cases were positive. The average gain was 73% and the median gain was almost 67%. Fair question. How concerning is this December 1999 case when ugly things eventually happened? We've covered this in the past, so we will move quickly. If you're familiar with ADX, you know when green is above red and black is above both green and red that this is an extended and vulnerable trend. And this is an extended and vulnerable bullish trend. Green above red. Present day case, we have almost the exact polar opposite. We have an extended bearish trend, vulnerable to reversing. In this case, we have black above both green and red, but there's a big difference. Red is above green. This is an extended bullish trend in 1998. This is a long-term period of consolidation in the present day, and this look here tells us that this decline here might be close to ending and reversing in this direction. You might say, Chris, I really don't care for ADX. That's fair. We can make the same argument with price. 1998 Value Line Geometric Index, if we look backwards from April 30th, 1998, 22 years, here is your extended and vulnerable trend. The average stock had gained over 600%. How did the exact same chart look if we look backwards 22 years in December of 2019? Extended and scary? Absolutely positively no. Looking back 22 years, we're up less than 10% on December 19, 2019. This is an extended bullish trend. This is a period of consolidation. Basically the same message from ADX. And common sense tells us this number here relative to this number here aligns with this quote here from Mr. Armstrong. Here's your angle of arrival here, and here's your angle of arrival here. Moving on, study number 2, monthly Bollinger Bands for the S&P 500. We're going to be looking at the S&P 500 going all the way back to 1949. Number 1, we want the S&P 500 to drop below the center line and get a close below the center line on a monthly basis. Number 2, we need to make a stand above the lower Bollinger Band and never close below that band. Step number 3, we need to rally off of that low, a correction, a low, a rally, and eventually get a close on the S&P 500 monthly above the upper Bollinger Band. How many similar setups dating back to 1949, and how did the stock market perform walking forward from the point that looks like this, which is similar to the end of calendar year 2019? Here's the answer. Doesn't happen very often. And since this happened at the end of December, this look here is telling us the fact that the stock market pulled back this week is not particularly shocking. The good news is 3 years later, 100% of the cases, here are your cases, higher, average gain 37%. 4 years later, from a point that is similar to the end of calendar year 2019, average gain almost 53%, all cases higher. Study number 3, risk on, risk off. We're looking at the S&P 500 relative to the VIX Fear Index. This time we're looking at a quarterly chart, end of December 2019, which is the end of a quarter. We get a bullish cross December 31st, 2019. How many similar setups dating back to 1998? Why 1998? Because we only have data going back that far. And how did stocks perform walking forward? We can see this, measure it, and put it in a model. We could see it, measure it, and put it in a model in 1999, 2004, 2011, and 2016. And once again, the fact that the stock market pulled back this week, not particularly surprising, seems to align with this table here. And for the most part, good things happened on this side of the table, with one exception being that calendar year 1999. And while anything can happen, the present day really doesn't look anything like 1998 or 1999. And thus, on this table here, if you toss the 1999 example, look at all of this green in here, telling us to keep an open mind about much better than expected outcomes if we can remain cool, calm, and collected for the next 1 to 6 months. Train kept it rolling all night long. Study number 4, technology versus bonds. Calendar year 2019 into 2020. This chart is dated January 23rd. This too is a monthly chart, and we're looking at a monthly MACD bullish cross, and we're trying to nail it down this month. Only have data going back to 2007, and it's only happened 3 times dating back to 2007, and walking forward from a look like this, really, really good things happened. Every single case was higher 1 month later, 2 months later, 3 months later, 6 months later, 9 months later, a year later, 2 years later, 3 years later, 4 years later, and 5 years later. Simply telling us to keep an open mind about much better than expected long-term outcomes, while respecting that we're always going to see volatility between a point A and a point B, even in the context of the strongest of strong bullish trends. This is the point in the video where we have reached study number 5. This is the NASDAQ Composite Tape Index. This is a little blurb about the NASDAQ Composite Tape Index. This looks crazy and confusing, but it's relatively easy to understand. This is Bollinger Band width down here. This is when our Bollinger Bands get narrow. You can see it right here. See the blue lines? They converge. This is your sleepy trendless market, or sleepy trendless indicator. See the indicator moves sideways. We're consolidating. This type of look here tells us to be open to a big move. It doesn't tell us necessarily whether it's going to be a bullish or bearish move. This is the present day look here, the sleepiest look that we have had on record going back to 1982. Similar sleepy looks occurred in 1995, 2002, 2012, 2016, and again in 2020. If you know your stock market history, you don't even have to see the table. You know this is a wonderful entry point. Fantastic entry point coming very, very soon from here. Market does extremely well walking forward from this point and this point. And all of that is reflected in this table here. The July 31st, 2002 comes a little bit early in here, but eventually really good things happen. See how narrow that look is in 1995? Very, very similar narrow look here after a period of consolidation. Here's what happened in the S&P 500 in the 1995 case, walking forward. All of the cases, 100% of them higher 1 year, 2 years, 3 years, 4 years, and 5 years later. Before we move on to study number 6, let's keep in mind these studies are exactly the same from an approach standpoint to the study that was posted on February 19th. February 19th, 2019, this post covered something that just happened, observable evidence, not something that might happen or could happen or something that we were worried about potentially happening. This happened. This table told us what happened next in the historical cases walking forward. In study number 6, this is what just happened. We don't need to predict anything. This is something that we can see on a chart and measure in a model. NYSE new high percent weekly. This is the percent of NYSE stocks making a new high measured on a weekly basis. This is an extremely oversold level here, and the same thing can be said for all of the examples below the blue line. If you know your market history, you know 1981, 1984, 1987, 1990, 2008, 2011, 2015, and thus far 2018, we're very, very close to outstanding entry points. And that would be outstanding entry points from a long-term perspective. In the present day, we dropped below the blue line, similar to the cases that we just covered, and then we made it all the way back to the green line, similar to this point here, 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 and all of these points here. How did the stock market perform walking forward? From a long-term perspective, extremely well. From a shorter-term perspective, once again, not particularly surprising that we've seen some give back in the present day. It's exactly what this table told us to be open to. At the end of the video, we're going to summarize all of the studies, so let's keep moving. Similar situations, study number 7, this time NASDAQ. Percent of issues above the 150-day moving average. We only have data going back to 2002. Extremely rare, this type of look that occurred late in calendar year 2018. Christmas Eve, to be exact, has only occurred 1, 2, 3, 4 other times in roughly the past 18 years or so. It's pretty rare. And the this just happened in the present day is making it back to the green line. If you would have bought in 2003, 2009, 2012, and 2016, and you know your market history, you know that you would have been very, very happy walking forward, which is exactly what the table tells us. 6 months, 9 months, 1 year, 2 years, 3 years, 4 years, and 5 years, every single case the stock market was higher. Once again, not particularly shocking that the S&P 500 dropped this week and that volatility picked up. Study number 8, something that just happened that we can see, measure, and put in a model. Extremely oversold condition on the breadth indicator, and then we were able to make it all the way back to the green line. Similar to this point here, and this point here, following major lows in 2002, 2008, 2009, and 2011. These were major lows. This is looking like a major low. And what happened next, walking forward from these points, aligns with the probability that 2018 was potentially a major low. 1 year later, 100% of the cases higher, average gain 13%. 2 years, 32%. 3 years, 42%. 4 years, 56%. 5 years out, we have an average gain of 73% and a median gain in the same basic territory, with all 3 cases being higher. Exactly what we would expect following a major low. Moving on to study number 9. MarketWatch article dated January 21st, 2020. Covers the latest Bank of America Global Fund Manager Survey. This is a scary looking headline here if you know sentiment. Fund managers most optimistic. That must be bearish. And fund managers have their cash at the lowest levels since 2013. That must be bearish. They're overconfident. The key here is 2013. You may remember, we've already covered 2013 in this video. This is early 2013, hardly a bearish period. This headline here aligns with the concepts that we covered in November of last year. What does this tell you? This tell you, and this gain from point A to point B tell you? It tells you that basically retail investors are late. 2013, for the most part, down in this region here, fund managers are in. Retail investors come behind and push the market higher for over 2 additional years, tack on an additional gain of roughly 36%. So if you're watching this video and you're skeptical, we know a lot of people were still skeptical in here because they were not back in yet. Let's take a little deeper look at this graph here from the Bank of America Global Fund Manager Survey. It's kind of noisy, but we'll walk through it. The graph shows the percent of respondents that say they're overweight equities. What just happened in the present day was we moved from an underweight position down here, which is relatively rare, up to the green line here. How many times has that happened? We only have data going back to 2001. The answer is it happened in April of 2003, May of 2009, and January of 2012. And if you know your market history, near a major low, near a major low, following a major low in 2011. And right now, this looks like we're following a major low that occurred in late 2018. This move here is similar to these moves here. What happened next? Walking forward from this point, and this point, which is similar to this point here. The answer? Really good things happen for a long period of time. Is it possible the current scare morphs into a major problem followed by a major top in the stock market? The answer is absolutely positively yes, it's possible. But this move here and these results here say it's most likely not probable, because this data set looks nothing, not even remotely close to a major top. Notice the data. Here's a major top, sideways, above this line here, above the line here, been up here for a while. Major top, been above the line for a while, going sideways. 2018 looks similar to this look here in 2011. And then really bad things happen in this data set. This is what today looks like. Doesn't look like this, this, or this, and it looks a lot like this, and this. And we know walking forward from these dates, similar to the present day, that really good things happen for a long period of time. This survey is global fund managers. They manage billions and billions of dollars. Turning that around is like turning a barge. Nothing is impossible, but it's not likely, given what we know today, that they're going to change their mind overnight. Keeping things moving, we just covered 9. This just happened. We can see it, measure it, and put it in a model studies. Using all of this, what can we learn about risk and reward over the next month to 5 years? Here are the results for all 9 studies in one place. And since we're skeptical human beings, our eyeballs will have a tendency to gravitate toward the concerning parts of the table. Therefore, it can be helpful to take this table and sort it. If we do that, we get a much, much better understanding of probabilities walking forward. This is S&P 500 performance 1 month out, 2 months out, all the way to 5 years out. These NAs down here are projections that we don't have data for because the signal didn't occur 5 years ago. We're not there yet. In this table, there are 455 cells with data. That excludes these cells here. Out of those 455 cells, what percentage produced a loss walking forward of greater than 10%? This speaks to risk. Well, from a probability perspective, this figure should calm you down. Only 12 out of the 455 cells have a loss of greater than 10%, and that represents 2.63% of the data. Visually, in this format, it's easier to answer this question. What percentage produced a positive return walking forward? This percentage should make you feel better if you're into probabilities. The answer is almost 85%. 386 of the 455 cells are green. Now let's take all of this data and do some very, very simple back-of-the-envelope calculations to see what we can learn. So let's summarize this data here. This is the 1 month column on the far left side where my cursor is. Looking out 1 month, 70% of the cases were positive. In the cases that were positive, the average gain was 2.79%. Back of the envelope, we can't expect to get a 2.79% gain because it's not 100% probability that we're going to even be green. So if we multiply this number by this number, we can reduce our positive expectancy. In terms of understanding probabilities, this column here, not unreasonable to think that we could make 2% walking forward. Let's do the same thing with the 5-year column. 90% of the cases were higher walking forward. In those cases, the average gain was 83%. If we multiply 90% by 83%, we get an expectancy of 75% using the back-of-the-envelope method. If only 90% of the cases were positive and 70% of the cases were positive, then it's logical that roughly 30% of those cases must have been negative, and roughly 10% of these cases on the right side must have been negative, and that is the case. In those 29.79% of the cases, the average loss in that subset was roughly 2%. 90% of the cases, good things happen, but 10% of the time, something really bad happened looking out 5 years. The average loss from these cases here, the subset, was 18%. Once again, if we take 18%, there's only a 10% probability in the data that it will occur. We get negative 1.81%. If we combine this back-of-the-envelope data with this back-of-the-envelope data, we can get a little bit better feel based on the historical data what the market's risk-reward ratio was walking forward from similar cases in the past. If somebody told us that we could invest our money and we would have a 90% probability of making 83% over the next 5 years and a 10% probability of losing 18%, from a stock market perspective, that is an excellent risk-reward trade-off. Is this method perfect? Absolutely, positively no. It simply gives us a reference point. And keeping in mind, we're looking at every single case here, even the 1999 cases. 1 year later, 91% of the cases higher. 2 years later, 91%. 3 years later, 96%. 4 years later, 95%. 5 years later, 90%. Here is the average gain for each case. I think it's pretty fair to say that the signals, things that we can see, measure, and put in a model, the things that just happened, these figures here, still wholeheartedly agree with this slide from November 27, 2019. And these cells down here help us keep an open mind about much worse than expected outcomes. How does all this help us? Number one, we are not making any predictions or forecasting anything. We're simply making probabilistic statements based on the facts that we have in hand today. All of the tables and the summary tables help us assess if our current allocation is prudent based on the facts in hand. Given these numbers here, if you are a client, I think you would agree that our current allocation is prudent. These are very high percentages looking out 1 to 5 years, and these are very satisfying average returns in those cases. The key here is, if the facts change, we must be 100% willing and able to adjust the probabilities and adjust our allocations if needed. That statement leaves the "this could get much, much worse" door wide open. No problem with that as long as we remain flexible. Let's talk a little bit about, have we seen enough so far to adjust the probabilities and or adjust our allocations? Let's answer that question in this context. The primary objective of all of this is to better understand what a normal and to be expected pullback might look like in the coming months. Knowing that will also help us with what an abnormal, this is not what we're supposed to be seeing here, pullback might look like. Based on all 9 studies, it wouldn't be shocking 1 month out to see the S&P 500 fall somewhere in the neighborhood of 2%. And looking out 9 months, it wouldn't be shocking to see the market fall somewhere between, let's say, 2% and 4%. We have to respect that this is the average loss in these cases here. 10% of the cases looking out 9 months were lower. In those 10% of the cases, the average loss was 4%, meaning in some cases, the loss was greater than 4%. What have we seen so far? The S&P 500 has dropped 1% from its recent all-time high. At this point, that is hardly alarming relative to realistic expectations. And look at these numbers here. These numbers here are based on studies that we performed this week. Look how closely they resemble what we covered last week. This is the 1995 case. Notice how the pullbacks get deeper as time goes on. These pullbacks range over the next year in this one case between, let's say, 2% and 4%. It's exactly what this table says looking out 9 months, between 2% and 4%. This number here, 92% of the cases the market was higher. And even in the 8 or 9% of the cases when we were lower a year later, based on the studies from this week, the average loss was less than 8%. So we haven't seen anything yet that starts walking away from the script. And if the facts change, in order for us to handle that properly, have to maintain maximum flexibility 100% of the time. No assumptions about what tomorrow's data will look like. No assumptions about what tomorrow's headlines will look like. This is, in essence, a roadmap that we can refer to walking forward, and it helps us with this objective here. Fundamentally, you can pause your video player. This headline, this data, does it align with or contradict everything that we've been talking about? It aligns with it. It aligns with all of this, because we know housing is extremely important relative to the health of the American economy. Just a quick reminder, 1995, 1996, 1997, 1998, 1999, and into the year 2000, we could have said, what about valuations? 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 And from this point here to this point here, with questionable valuations, questionable inside of quotation marks, the S&P 500 tacked on an additional 232%. How do we handle this walking forward? We don't have to change a thing. We handle it with maximum flexibility, While respecting if the facts change in a material manner, we must be 100% willing and able to adjust the probabilities and adjust our allocations if needed. The market and the data will make that call. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.